Welcome to Choosing a Lender with your host, me, Joseph J. White. In this tutorial, we will be covering the following topics. Number 1, types of lenders. Prime mortgage lending, subprime mortgage lending, and the private mortgage market. Number 2, understanding lender guidelines. We'll be looking at product sheets and rate sheets. And number 3, choosing a lender. So, let's get started. Introduction. Once the mortgage agent has decided on the best product type for his or her client, it is now necessary to choose a lender. There are currently dozens of lenders in the mortgage market, and choosing one specific lender to submit a client's application to can be time-consuming and confusing if the mortgage agent is not knowledgeable on lenders' products, services, and rates. In this module, the different types of lenders will be explored as well as varying lenders' guidelines. Since lenders have different methods and styles of promoting their products, a sample of a lender's product sheet will be reviewed. However, for the mortgage agent to be fully aware of lenders' products, services, and rates, it is necessary for him or her to develop relationships with those lenders. For the mortgage agent who is joining an established mortgage brokerage, those relationships are typically already in place. In this circumstance, the mortgage agent needs to ensure that his or her contact information has been provided to the lenders with whom the brokerage deals. The mortgage agent needs to review all of the current information that the brokerage has on those lenders. Types of lenders. Canada has dozens of lenders from which the mortgage agent may choose. It's important for the mortgage agent to know who those lenders are and the products, services, and rates offered by each to determine the best lender for his or her client. Many lenders have a dedicated mortgage broker sales force comprised of business development managers, or BDMs, or business development officers, also known as BDOs. There are other titles that some lenders provide to their sales force, but the terms BDM and BDO are most common. These individuals are tasked with obtaining business from mortgage brokerages and are normally a valuable source of information on their lenders' products, services, and rates. In addition, a BDM can often assist a mortgage agent to have an application approved by liaising between the mortgage agent and the underwriter. Lenders are typically categorized by the type of business in which they specialize, either prime mortgage lending or subprime mortgage lending. Now let's take a look at prime mortgage lending. Prime mortgage lending is defined as lending to clients who are considered to be prime borrowers. A prime borrower is typically an individual who has excellent credit, provable income, and stable employment. This type of lending is often referred to as A lending or prime lending. The majority of Canadians fall into this category, as is evidenced by the volumes of mortgage transaction completed by prime lenders. Typical prime lenders include those who deal directly with the public, such as chartered banks, trust companies, and credit unions. There are also several lenders who deal with the public only through mortgage brokerages, and these institutions are normally non-deposit-taking institutions. Subprime mortgage lending. The subprime mortgage market has developed in Canada over the past several years in response to Canadians with specific mortgage financing needs who were and are not serviced by the lenders in the prime mortgage market. While some prime lenders also offer forms of subprime products, they are typically offered to Alt-A borrowers. An Alt-A borrower is normally an individual whose credit may be good, although not excellent, and who may not be able to prove his or her income, but is still considered a good risk by the prime lender. The increasing subprime mortgage market provides the ability for borrowers who have been, or who would be, declined by prime lenders to obtain financing, either to purchase a home or refinance their existing mortgage. This market has effectively increased the number of potential home buyers by providing financing that would otherwise be unavailable. Although this is viewed as a positive development in the mortgage market, it has also resulted in borrowers being approved who perhaps should not be. The typical subprime borrower is an individual who may have a combination of the following characteristics: current poor credit, such as being behind on his or her payments on one or more credit cards, loans, or other debts; less than 2 years at his or her current job; self-employed; has a previous bankruptcy; has previous poor credit with no re-established credit; requires high loan-to-value financing. While no single characteristic from the above list may be enough for a prime lender to decline an applicant's application for financing, a combination of those characteristics typically will result in being declined by a prime lender. It has therefore become necessary to provide potential borrowers with alternative financing, which is offered by subprime lenders. These lenders normally charge a higher rate of interest than their prime counterparts and may charge the borrower a lender's fee. A lender's fee is a fee charged by the lender, normally paid on closing by the borrower, from the mortgage proceeds, as a bonus for providing the financing. These lenders often refer to their lender's fee as a self-insurance fee, and many will call themselves self-insured lenders. This simply refers to the fact that they do not offer default-insured mortgages. Rather, they charge a lender's fee that is designed to offset the risk of default by a borrower. Many of these lenders charge fees similar to that of the default insurers, but it's important to note that the term self-insured is simply used as a way of explaining their lender's fee, as these lenders do not use any type of default insurance. Success tip: subprime lenders. Most successful mortgage agents will have between 2 and 4 prime and 2 and 4 subprime lenders with whom they normally deal. By choosing a handful of lenders with whom to work, you will become familiar with their guidelines and develop relationships with their BDMs and underwriters. It is, however, also important to know the other lenders' guidelines in case your normal lenders cannot fund a specific transaction. Now let's have a look at the private mortgage market. Private lenders are classified as individuals or groups of individuals who provide mortgage financing. These individuals have money to invest and have decided that mortgage financing offers a profitable rate of return. The typical private lender will deal with mortgage brokers or brokerages and use these individual firms to locate potential clients. A client requiring a private mortgage will generally not qualify through a prime or subprime lender. This client will normally have equity in his or her house and be able to obtain financing to a maximum of 85% loan-to-value, depending on the area in which the property is located. Private lenders will charge a higher rate of interest than prime and subprime lenders and will normally charge a lender's fee. The profile of a typical private mortgage is an interest-only mortgage with monthly payments and a 1-year term. Section 2, Understanding Lender Guidelines. Lenders, with the exception of private lenders, provide mortgage agents with summaries of their products, services, and rates. These documents are often referred to as rate sheets and product sheets and are normally communicated to mortgage agents via the lender's BDM, by email, or are provided on the lender's website. A username and password may be required to access this information online. Some lenders have packages that describe their products in detail, while others provide basic summaries. Now let's have a look at a product sheet. A product sheet is designed to inform the mortgage agent of the terms and conditions that must be met for approval, as well as the features of the mortgage being described, including the maximum loan-to-value, the amortization, and so on. Now, the fact is that product sheets differ from lender to lender, but what we've been looking at as I've been talking with you is typical information that's found in most lenders' product sheets. You can have a good close look at this by checking out Figure 1 in your course manual. Now, a rate sheet, on the other hand, is designed to inform the mortgage agent of the rate charged on a product based on such factors as the loan-to-value and the beacon or credit score. While the format of rate sheets differs from lender to lender, what we're looking at now is a sample of a rate sheet that contains typical information. This is also in your course manual. Now let's have a look at choosing a lender. If the mortgage agent determines the best product for his or her client, and only one lender in the industry offers that product, the choice is clear. However, this is not always the case. In all circumstances, it is best to rely on the advice of the brokerage for which the mortgage agent works. However, if the brokerage does not specifically recommend a lender, then the mortgage agent should use the following points in determining the best lender to choose. Loan-to-value. Which lenders offer the loan-to-value that the client requires? Income verification. What income verification is required? Can the client provide the appropriate documents? Property type. Does the client's property type meet the lender's requirements? For example, if the client has a rental property, does the lender have a rental product? Credit score. What are the lender's requirements? Does the lender offer a different loan-to-value based on credit scores? If so, does the client qualify? Then we look at terms, rates, speed which the lender provides the quickest response, service, reputation of the lender, brokerage preference, relationship. Do you or does the mortgage agent have a good relationship with the lender, BDM, or underwriter that creates loyalty to that lender? And then we get into the last two items here that should be least important, and they are finder's fees and loyalty programs. So with the case of finder's fees, if everything else is equal and two or more lenders are appropriate for the client, which of those lenders, if any, pays the highest commission is a valid question to ask. If everything else is equal with regards to the transaction and two or more lenders are appropriate for the client, which of those lenders, if any, offers a loyalty or points program? That's another valid question. In all cases, the right lender must be best for the client, regardless of the finder's fee or loyalty program that the lender may or may not have. By consistently doing what's in the client's best interests, the mortgage agent will increase his or her chances of becoming highly successful. And that brings us to the end of this module. Your next step is to ensure that you read the chapter in your textbook and complete the chapter review questions. The answers to those questions are at www.remic.ca.